All right, great. We're glad you agree that future tax rates are going to be higher, and then you went ahead and joined us for the second part of our informative videos. So we're going to focus on two main aspects here, that making sure that you don't pay more than your fair share of taxes, and we're going to try to find ways to help you battle inflation by making your money do more for you. So the key thing here is for you to wrestle control of your taxes out of Uncle Sam's hands and put you in control of how much taxes you'll pay. The video is specifically made for those who are in retirement and have between 2 and 4 million, or those that anticipate they're going to have between 2 and 4 million when they get to retirement in qualified money. So qualified money is 401k, 403b, 457 plan, IRA, SEP, Keogh, even pension money. So if you don't know what a SEP and Keogh are, you're probably not self-employed. So if that isn't you, if you're not going to be in that arena of money, then click the back arrow and go back and choose the right option, because the numbers on these different videos vary quite a bit. So a key stat to remember from our first video was 81% of Americans make less than $75,000, 90% make less than $100,000. So it's difficult to boost income taxes on those people because they don't have that much money, and they represent a majority of the voting public, right? Here's something we didn't share. Median 401k balances for ages 50 to 59 is $62,700. For ages 60 to 69, it's $63,000. For ages 70 and up, it's $52,400. If you look at IRAs, they're similar to that, so you can basically double that. It's still not a lot of money there, so it's almost impossible to generate much tax income from those folks either. So here's what this means, okay? And it's important because if you're sitting there with 2 to 4 million, as Uncle Sam needs more and more tax revenue, he's going to continually lower the bar to whom he defines being wealthy. I'm going to bet you $1 million that you're going to be considered wealthy because you're here, you've done, or you're going to do quite well with your retirement savings and qualified plans. So, my friend, you have a huge bullseye on your wealth, okay? So it is great that you're here, but you're also going to need to take action to make the moves needed to make sure that you don't get stuck paying more than your fair share of taxes. All right, so we're going to begin with the assumption that we've got a married couple that's age 65 and older, okay, between $2 and $4 million in qualified accounts. Okay, we're going to assume Social Security income is $30,000. Now we chose that $30,000 number because the average person is getting $15,000 a year in Social Security. If you had enough financial wherewithal to create $2 to $4 million in wealth, you're probably going to have a higher Social Security. We can run it on a higher number. We just kind of try to keep these pretty in line as we went through. 2021 standard deduction is $27,800. Okay, and where did that come from? Well, the 2021 standard deduction for married filing jointly is $25,100. So if you were under 65 and watching this, that's fine. It changes your numbers just a little bit by about $2,700 in the standard deduction, which makes a small difference in things. And the reason you get the extra $2,700 is because if you're age 65 and older or blind, you get $1,350 per person that meets that criteria. So that adds the $2,700 in our scenario. So what we're going to do here is tax rates are low now. We're worried about them we're concerned that they're going to be higher in the future. So we want to take out as much money as we can that is still efficiently done because tax rates are low. So we're going to blow through the 10% tax bracket it's $19,900 wide. We're going to blow through the 12% tax bracket. It's $61,150 wide. We're going to blow through the 22% tax bracket. It's $91,700 wide. And we're going to blow through the 24% tax bracket. It's $157,100 wide. So we're going to have total income of $387,650. So what we're doing, we're not assuming you're living on $387,650. We'll go through a hypothetical assumption here in just a minute, and all these are hypothetical, by the way. But we're just talking about we're going to do. There's an efficient way to take out $387,650 from a tax standpoint. Interestingly, though, you're only taxed on $383,150. Why is that? I'll show you in just a minute. All right, so the standard deduction is important. And now, retirees, not very many of them itemize. With your wealth, you may itemize. If you do, this makes this number higher. And this number is significant because it's essentially the amount of money we're able to take out, for the most part, income tax free. When you mix in Social Security, you probably aren't going to be able to pull out the full $27,800 without at least paying a little bit of tax on that. Okay, so it's important that we get that number as high as we possibly can. So the next $19,900, you're paying $1,990. In the 12% tax bracket, we're paying $73,388. In the 22%, we're paying $20,174. In the 24%, we're paying $37,704. So here's where we get into why the taxable's not quite as much. we pushed the Social Security income into the 32% tax bracket. Why did we do that? Because we don't get taxed on every dollar. The maximum we get taxed on is 85%. 85% of 30 is 25.5. So that's why our taxable income is only $383,150. That $4,500 is subtracted there. So there's $8,160 in taxes there. So our total tax bill on $387,650 is $75,366. Now, this is federal tax only. I didn't include state because every state is different. You could live in Florida and not pay any, or live in California and live in New York and pay a whole bunch. So we just did federal. Okay, it still makes sense with state taxes, because if federal income taxes are going to go up, there's a good chance state taxes will too. So what this means is you could pull out $3.876 million over 10 years and only pay $753,660 in taxes. And over 20 years, you're able to pull out $7.751 million and pay $1.507 million in taxes. So everybody always focuses on the marginal tax brackets. Oh my gosh, I'm paying 32% taxes. Well, only on $25,500 in this. We want to focus on our effective tax rate. And the effective tax rate on this is 19.44%. So you think about that. I can take $387,650 out and pay less than 20% in taxes. That's pretty powerful. And folks, that's the best it's ever going to be for you, because we can't travel back in time. I haven't figured out how to do that. Although if you want to leave me your name and email, I'll let you know if we figure that out, because then we can make some real big changes. All right, so I want to talk about something first. I want to bring this up. So since you've got $2 to $4 million, there's a really good chance you'll leave money after you're gone. Okay, so any amount of qualified money that's passed to a non-spousal heir, so your kids, okay, is fully taxed at their highest marginal tax bracket, and it can also move them into a higher marginal tax bracket. Also, a couple of years ago, they changed the rules that your kids will only have 10 years to pull all of this money out. They used to have what we called it the stretch IRA, where they would base it on their life expectancy. So if you died, they were 35 when you died, they might have 30, 35, 40 years to be able to pull that out. Well, now they have 10, okay? So let's assume you died with $2 million balance over 10 years. That's $200,000 a year withdrawn. Let's assume you have 2 children, $100,000 a year for each. Let's assume they're both married and with $106,150 incomes. I chose that because in 2021, they're at the top of the 12% tax bracket. So they'd pay 22% federal taxes, plus whatever state if there was, on $91,700, because remember that's as wide as our tax bracket was for the federal for 22%. So they paid $20,174 at 22%, and then they paid 24% on the remaining $8,300. So $26,56. So a total of $22,830 is how much their federal tax will be. But remember, you're here because we think future tax rates are going to be higher. So could this be considered money from someone wealthy? Well, yeah, almost certainly so. If you leave $2 million behind for 2 kids, it's going to be considered for some money from someone wealthy. So it's going to be a tax target as they're trying to raise tax rates. So what if it was 40%? Well, that's $40,000 a year in taxes. 50,000 a year in taxes. What if it's 94%? Oh, Kurt, you're crazy. It's not. So here's the thing. If we don't understand history, we're doomed to repeat it. So I want to point this out. This actually happened, okay? 1941, the highest marginal tax bracket was 94% on incomes over $5 million. And you're like, come on, Kurt, $5 million, you're crazy. Yeah, you're right. If I stopped there, I would be crazy, because $5 million is a lot today in income, and it was a lot more in 1941. But here's what, if you remember 1941, it had some significance. There was a little thing that happened in December 7th. My favorite line from the movie Animal House was it over when the Germans bombed Pearl Harbor? Well, it wasn't the Germans, it was the Japanese, which drew us into World War II. So Uncle Sam knew we needed tax revenue to fund the war. In fact, the last time our debt to income, our debt to GDP was as high as it was in World War II was about 3 years ago. Okay, and our debt to GDP is higher now than it was during World War II when they needed to raise taxes, right? Interesting. So here's what they did. In 1942, they redefined who was wealthy, and instead of that $5 million and above being taxed at 94%, they rolled it down to $200,000. I get it. $200,000 is still quite a bit of money, especially in 1942. Right? But what I'm showing you here is they did a huge change in what they defined as being wealthy. Okay? They dropped that 96%. That's crazy, right? So, and here, let me add to this. I'll give you a little story on this. Former President Ronald Reagan was an actor in the 40s. He was making $100,000 a movie. It took him 3 months to make a movie. So in 1942, he's a smart guy. He figured this out. He did one movie from January to March, and then another one from April to June, and quit working because he made $200,000. He knew that for every dollar he made over that, he'd have to give 94% to Uncle Sam. He lived in California. He's going to have to give, well, actually it was higher than 6%. He'd have to give, so technically he could make an extra dollar and have to come out of his pocket, not get any of that dollar and still pay taxes on it. Now, they wouldn't have done that to him, but they literally would have taken every dollar he made, which means wealthy people change what they do. So I'm not saying making movies is being productive, but if they were, a company that was producing stuff, whatever, there's going to be changes, and it can really impact us. I don't think marginal tax rates are going to go back to 94%, but I do see significant changes in who's wealthy, okay, who they deem to be wealthy. All right, so here's our assumption. What if we assume that this couple had $3 million in qualified money and they're living on $175,000, okay? If they did that, in federal taxes, they'd be paying $29,941. So here's the question. Remember, our number here was $387,650. So would it be beneficial to pull out an additional $212,650 of fully taxable money? It costs, $45,425 in federal, not state, federal income tax. Okay, so think about this. In 10 years, you'd have paid $454,250 in taxes and pulled out $2.1 million, $2.126 million. Okay, pretty strong, right? Over 20 years, you'd have paid $908,500 and pulled out over $4.25 million in income. Okay, so that what we've done there is we've taken forever taxed money, we paid the tax on it at the lowest that we could, and create never taxed money. That's our goal here. We want to create never taxed money with this after we pay taxes. And we can do that. We'll show you the strategy here in just a little bit. All right, so think about it. If you can eliminate federal income tax liability on $387,650 for less than 19.5%, because our effective tax rate on that's 19.44%, wouldn't you do that? I would do that all day long. I would wish I could take out more. Unfortunately, when we go above that, it raises our effective tax rate. So we found this was kind of the sweet spot for that $2 to $4 million in qualified money, right? All right, so we're going to assume we're taking out that additional $212,650, paying $45,425 in taxes. Now I round this down. Okay, I'm just going to call it $160,000 after everything. Okay, so what could we do with that $160,000 to continue our goals? We want to grow it, right? We want to protect it. We want it to grow tax-free, and we want to make it do more for us, correct? That's what our goals were. That were our ultimate goals when we come into here. All right, so I'm going to take a male and a female, and you'll see. I wanted to do one of each because there's a little different changes the numbers just a little bit whether you're male or female. So I wanted to show that. So what if we took $80,000 for Mr., $80,000 for Mrs., and we safely bundled that into a tax-free wrapper? So it protects the money from loss. It's linked to the market, protects the money when the market's down. It grows the money when the market's up, locks it in every year and protects it. And that money that money grows tax-free. It's tax and penalty-free accessible. Okay, got to follow a couple rules. We have rules for everything. I'm not going to go into details on that. Be happy to, we can get into all the minutia of that if you're interested in finding out more about this. So we've protected it. Okay, we wanted to do that. We can grow it. All right, with market type returns. It's growing tax-free. It's accessible. Right? What do we needed to do now? We needed to multiply, right? So if you put that $80,000 into the right strategy, it creates $950,000 in death benefit for the Mr. and $1 million for the Mrs. This is why I did Mr. and Mrs., a male and a female here, okay? Because the numbers are a little different, all right? Now ignore the numbers right below those numbers, and I'll come back to them. So over 10 years, you would have pulled out $800,000 for Mr., $800,000 for Mrs., and so they got cash value of $800,000. Now I didn't even show any growth here, and I've got a method to my madness. I'll explain that here shortly. We're assuming no growth on that money. Now, the way this is structured, I'm not going to lose money when the market's down. I'm grabbing gains when the market's up to a cap. If the market does what the market's always done, it's going to grow. I mean, if the stock market went down 10 years in a row, and this was your worst case scenario, what would your money that was in the stock market have done? It would have been decimated, right? The stock market's never done that in the history of the stock market. I'm not saying it couldn't happen, but it just never has happened. So this is showing absolutely no growth on it, okay? That means we got 1.6 million, right, after 10 years in tax-free money that we could be accessing. You could be using this money to increase your lifestyle, to supplement your income, whatever, okay? Whatever you want to do. You could find other growth strategies with it if you want it. May not be tax-free, but we could make them, more tax efficient. Over 20 years, it's 1.6 million in each account, so we've got $3.2 million in cash value, okay? So this is showing no growth. Remember that, shows no growth. More than likely, you would get really good growth. I mean, you typically, historically, you've seen 5, 6, 7% a year growth on average, actual returns in that amount, and that's all tax-free growth. So that's really strong, right? But after 20 years, we're going to make an assumption that you didn't spend any of this cash value on either of you, and Mr. dies, okay? So what would happen when Mr. dies? Well, that 1.6 million is part of the death benefit. It passes to Mrs., okay, income tax free, and then the $950,000 in death benefit passes income tax free. So this is right now the estate. It could be susceptible to estate tax. The estate tax exemption for him would have been about 11.5 million. The new administration wants to reduce that to 3.5, which means it's 23 million for a couple and down to 7 million for a couple. So we'd still, in this scenario, would still likely be under any estate taxes. So now here's what happens. He dies. Mrs. is sitting on basically 4.15 million in cash, okay, because she's got access to that. Now, we would create a strategy for her to do something with that 2.55 million that she just inherited, okay. But I digress. I'm not gonna get into that right now. So we'll let that be. But you would have some strategies for that. So what you've done here is you've taken 3.2 million out and paid $908,500 in taxes. Created tax-free access, tax-free growth, and we multiplied what these dollars are doing. Right? We've met our goals, have we not? Right? But let's take this a little bit further. Let's assume you never met me, okay? And we're back to the $3 million in your 401k, and let's assume you've got it down to $2 million, and Mrs. You never met me, and Mrs. now needs long-term care. Okay, Mr. dies, didn't really leave her anything other than what was in his part of the 401k IRA, right? And we're going to assume it costs $80,000 a year. So do you know that 40% of the folks that died from COVID, as many as 40% of the folks that died from COVID, died in nursing homes? So would you ever put someone you love into a nursing home if you didn't have to? Right? Wouldn't you prefer? Yeah, I mean, you love yourself, right? So you want choice, you want control over that, right? I mean, I think most people, if they're going to have that type of care, would want it in their home. So wouldn't it be nice to have the money to be able to do that? Right. So if she lasted 2 years, that out of that 2 million, so that's 160,000. So it's there 1.84 left that the kids would have to pay taxes on all that money. Remember, I showed you how that worked already. That's what would happen if they'd never met me. If you'd never met me, but now that you've met me, why don't we change this up a little bit? All right. So now we'll go back to this scenario here. So she's got plenty of cash, right? I mean, she's got 4.15 million. So that 160,000 is a drop in the bucket. So she pays all of that, dies. So all that remaining money passes to the heirs, and along with the million. So the kids get 4.99 million tax-free. Okay, income tax-free, and more than likely, unless they really drastically change the estate tax-free. Okay, it's pretty strong, is it not? I mean, haven't we multiplied those dollars? All right, so now we back up and let's change the scenario and say that you spent all of that all that $3.2 million, which is fine if you want to do that. That's fine. In fact, having that extra death benefit gives you permission to spend more. Let's say you wanted to increase your lifestyle, whatever. There's a million reasons why, and I guess I should say maybe an infinite number of reasons why you could spend all that money. That's fine. So let's assume that we spent all that money, okay? These death benefits are interesting because you don't have to die in order for them to be beneficial. Obviously, you can see in the benefit of having them structured this way. But what happens is, let's say, burn through all that money and Mr. needed some long-term care, but they don't have any cash. he can take out up to about 20 to 25% of that up to $20,000 to $25,000 of that $950. So all but that amount he can take and help pay for his long-term care. Okay, so whatever he doesn't use would pass on to Mrs. if she outlives it. Okay, so in this scenario, if she had run through all of her $1.6 million, she would have $1 million available. So in that scenario, paid $160,000, so she'd have $840,000 that would pass to her heirs income tax free. So there's lots of different little things that could happen here. All right. So do you know anything in the world that can do something like this? You know what it is? It's cash value life insurance. I know cash value life insurance has got a horrible reputation, and in some certain, and nothing's perfect. Okay, you can structure these things to where they benefit the agent more than the client. What we've done is through the tax law changes in 84, 86, and 87, TAMRA, TEFRA, and DEFRA. This is the most money we can put in to buy the least amount of life insurance. So we've minimized the costs to make it most beneficial for the client. Now, you could say, you know what, I need more than 950, and she says, oh, I need more than $1 million. That's fine if you make that choice. We can certainly do that. It adds to the cost a little bit. It's not as efficient. It's still very, very good. And I would make more money. I get paid on how much death benefit there is. So if it raises the death benefit, I get paid more. Okay, that's why they claim, oh, they're just chasing more money. Well, if you structure it to where it's not as efficient as possible like this, without the client knowing, then that's true. You are taking advantage of it. But if the client says, you know what, Kurt, 950 is not enough, $1 million is not enough, we each want $2 million. Okay, that's great. It just won't be you won't have as much growth in it. It won't be quite as efficient. All right, but it'll still be really good. And actually, the kids will more than likely end up with a lot more. Or we'll end up with more because you have a higher death benefit. So I hope that makes sense. All right, so here's the thing. If you're interested in seeing how this might work and look for you and get more details, and you can start grilling me on all the horrible things you've heard about cash value life insurance, okay? I enjoy when people do that because I get to dispel a lot of myths. We're going to do a 30-minute, no hassle, no cost strategy call, okay? And it's actually online, so we can, we've got a calendar. My online calendar is below, so if you're interested in that hassle-free strategy call, just find a time when you've got 30 minutes in front of your computer that we can do a virtual call, and I will, once you book that, I will send you a link to our secure video conference room, because we'll be talking about some financially sensitive things, so we don't want to make sure that there aren't any prying ears listening in or eyes watching. So go ahead and click that, the online calendar below. If you want to call me, here's my contact information. You want to email me, that's fine too. But I'm happy to answer those questions for you in that call. And then the nice thing about the strategy call is you've got 4 choices when you're done with the strategy call. You can do nothing, continue whatever you're doing now. You can try to do it on your own. You can go back to your current financial person and ask them to do it for you. Although if they haven't shown it to you, I'm not sure why anybody in the world would want to do that. And full disclosure here on the 4th option, it's our favorite because you ask us to help you, right? And we're happy to do that also. So, hey, I want to thank you for sticking around. I know this went probably a little longer than what you were expecting, but hopefully you got some really good information out of it. Look forward to hopefully having the opportunity to talk with you soon. Thank you very much.